Welcome to your own channel, where we learn everything about civic sense and government schemes. Today, we're diving deep into one of the largest financial inclusion initiatives on the entire planet, India's Pradhan Mantri Mudra Yojana, or PMMY for short. Now, this is a scheme designed to empower the smallest of businesses with the one thing they need most, capital. And the scale of this thing? Well, it's truly mind-boggling. First off, let's just take a moment to absorb the sheer scale of what we're talking about. Since it kicked off in 2015, the Mudra scheme has given out loans to over 34.93 crore borrowers. Let me say that again, 34.93 crore. To put that in perspective, that's more than the entire population of the United States. It's an absolutely staggering number that really points to an incredible ambition. And that's the real question, isn't it? I mean, beyond these massive numbers, what's the actual impact? Has this flood of money really created a nation of thriving entrepreneurs? Or, are there deeper stories hidden inside all that data? That's exactly what we're here to find out. So, to really get a grip on the impact of the Mudra scheme, we have to go back to the beginning and understand the problem it was designed to solve. It's all right there in its mission statement: funding the unfunded. Let's break down what that really means. Okay, so what is it exactly? Well, PMMY is a government initiative that gives out loans without asking for any collateral. That means no property, no gold, no assets you have to pledge. And it specifically targets the smallest players in the economy. We're talking about the non-corporate, non-farm micro and small businesses. Think street vendors, tiny shopkeepers, artisans, and local service providers. This slide right here really gets to the why behind the whole scheme. Before Mudra came along, India's micro-enterprise sector was staring at a massive credit gap of almost 17 lakh crore rupees. Can you believe that? Over 80% of these businesses were just completely cut off from formal banking. They were often forced to go to informal lenders who charged sky-high interest rates. PMMY was created to bridge this enormous gap and bring millions of entrepreneurs into the formal financial system. So, how does it all actually work? Well, the scheme isn't just a one-size-fits-all loan. It's actually structured more like a ladder, and it's designed to support a business as it grows. And this is just a brilliant way to understand it. It all starts with Shishu, which means infant in Hindi. These are the smallest loans, up to 50,000 rupees, perfect for just getting a brand new idea off the ground. Once a business starts to find its footing and needs to expand, it can climb up to the Kishore, or adolescent stage, with loans up to 5 lakh rupees. And finally, for established businesses that are ready for a major expansion, there's the Tarun, or youth category, which goes all the way up to 10 lakh rupees. It's a super clear pathway from startup to scale up. All right, now that we know the what and the how, let's get back to those numbers, because the story they tell about the scheme's reach is just incredible. The scale is something you really have to see to believe. Just look at these figures. As of early 2024, a total of 18.39 lakh crore rupees has been sanctioned. To put that in perspective for you, that's over 220 billion US dollars. And this massive amount has been spread across those 34.93 crore loan accounts. It's just an unprecedented injection of cash into the grassroots of the Indian economy. So where is all this money going? Well, this table shows us the top 3 states by loan disbursement for the 2023-24 financial year. You've got Uttar Pradesh, Bihar, and Tamil Nadu leading the pack, each seeing well over 50,000 crore rupees given out. What's interesting is that while Bihar has the most borrowers out of these 3, the total loan amount is a little less than Uttar Pradesh. This kind of suggests a lower average loan size per person in that state, and it gives us a little hint about the regional differences in how the scheme is actually being used on the ground. Okay, this brings us to the real heart of our analysis today. The whole scheme was built on this promise of inclusion. So, has it delivered? Well, the answer, as we're about to see, is complicated. It's a story of some incredible successes, but they're shadowed by some pretty persistent inequalities. First, let's talk about the big success story. This is huge. Around 71% of all Mudra loan accounts belong to women entrepreneurs. This is a phenomenal achievement in empowering women financially and really bringing them into the business world. The scheme has, without a doubt, opened doors that were previously shut for millions of women. But let's look a little closer. And here's the catch. While women are getting loans in record numbers, a detailed study uncovered a clear disparity. On average, the loan amount given to a female borrower is about 13,400 rupees less than what's given to a male borrower. So what does that tell us? It means that while access has definitely expanded, equity in the actual loan amount, that still seems to be a major challenge. And this pattern isn't just about gender. When we look at the data based on caste, a very similar story emerges. Borrowers from scheduled castes, scheduled tribes, and other backward classes hold a pretty big chunk of the loan accounts, over 35%. But their share of the total money handed out is much, much smaller. This again points to the fact that they too are mostly getting the smaller ticket loans. And this number right here puts that disparity into stark focus. The same study found that when you account for all other factors, a borrower from a scheduled caste gets a loan that is, on average, a staggering 2.84 lakh rupees less than a borrower from the general category. The big takeaway here is that while the scheme has opened the door to credit, it looks like deep-seated systemic biases are still influencing who gets access to the larger, more life-changing amounts of capital. Now, beyond this issue of equity, some other worrying trends have popped up over the years, revealing some potential cracks in the system. And these challenges raise some serious questions about the scheme's long-term sustainability and whether it's really effective for one of its key target groups. One of the main goals of Mudra was to empower first-time entrepreneurs. And in its early days, it was a huge success at this. In 2016, 36% of all loans went to new business owners. But just look at this timeline. That share has been in a steep decline. It dropped by half by 2019 and hit a low of just 12% in 2022. Now, there's been a slight recovery recently, but it's nowhere near those initial levels. So the big question is, why is it getting so much harder for new entrepreneurs to get a Mudra loan? Well, there are a few reasons, and they're all connected. First, as the number of loans ballooned, so did the number of defaults, or what banks call non-performing assets. This was a particularly big problem in that initial shishu category where most new entrepreneurs start. So what happened? The banks got more risk-averse. They tightened their rules, they demanded more and more paperwork, and that created a much higher barrier to entry. And at the same time, a lot of first-time borrowers just don't have the financial literacy to create the kind of convincing business plan the banks now want to see. This slide perfectly illustrates that barrier. I mean, look, to get a small shishu loan, the paperwork is pretty simple. Basic ID, some photos, and a price quote for what you want to buy. But look at the jump when you try to move up to the Kishore and Tarun categories. All of a sudden, you need extensive business licenses, 2 years of audited balance sheets, projected financials. The list just goes on and on. For a small street vendor trying to grow their business, this leap from simple paperwork to highly complex documentation can feel like an impossible wall to climb, effectively trapping them in that microloan category forever. So after looking at the massive scale, the mixed report card on inclusion, and these systemic challenges, where does that leave the Mudra scheme? What's its legacy, and what does the road ahead look like? Look, there's no denying it. PMMYY has been a monumental success in terms of financial outreach. It has connected hundreds of millions of people to the formal banking system for the very first time, and that is a huge achievement. However, the data also shows us that access doesn't always equal opportunity. There are still major hurdles to overcome in ensuring equitable loan sizes across gender and caste lines and in really helping the smallest businesses climb that ladder from Shishu to Tarun. And this leaves us with one final and really vital question. Is providing the capital actually enough? Can a loan scheme, no matter how huge it is, single-handedly create a thriving entrepreneurial ecosystem? Or does true success require more comprehensive support? You know, things like financial literacy training, business mentorship, and help navigating the very same documentation that can become a barrier to growth. The Mudra scheme has definitely funded the unfunded, but the journey to building sustainable, successful businesses, well, it seems like that has only just begun. If you liked this information, support us with a like, share, and subscribe. And hit that bell icon to get the latest updates from us. And hey, if you want a video on your choice of scheme, do let us know in the comments section.